Safari Source Nation, I'm here with Garth Grant from Stratmor. He needs no introduction, but if there's realtors or lenders that don't know, I guess the easiest way to explain what Garth does is, if you have a CFO or a CEO that runs a big company, maybe even a smaller company, maybe even credit unions, and they want to run a strategy by somebody, they call Garth. They call Stratmor. They work in mergers and acquisitions. So they're really working with high-level people and working through profit and losses and running strategies. So realtors, this is going to be a bit of a high-level conversation. I don't know that I would tune out though, because this definitely affects the future of the industry, and obviously we need lending to sell houses. So, Garth, thanks for being here again, man.
No problem. Yeah, no problem. By the way, I do often deal with strategy, but today I'm actually going to talk with a number of tactics of what I would do if I was an originator, which, by the way, I used to be.
Perfect.
So I started in the business 30-some years ago as an originator. So I remember what that was like. And I've been through a number of the crises, so I'll comment on that. And our partners in the real estate industry absolutely are part of the same team picture. Their customers under stress are going to call them too.
Yeah.
So I think the more we understand about what's happening in the industry and what we ought to be doing on how we communicate with consumers and borrowers under stress, I think the better off we're all going to be.
Yeah, guys, there's no bumpers today, so we're going to go anywhere because there's so many challenges that we're all facing. It's fluid. I was on a call with David Stevens, Ivy Zellman, Barry Habib yesterday. Some of what we talked about has already changed. So I'm real curious. We'll start with the bigger challenges. Kind of want to hear your opinion on, I asked Barry yesterday, hey, is the margin call issue behind us? He thinks it is. I'm hopeful. I'm not so sure. Kind of your thoughts on that. Servicing is still a big challenge right now, and that's having, and it's hard to explain on a realtor level or consumer level, but if you're seeing overlays on like FHA and VA, it's because some of the servicing challenges. So I'll kind of throw to you for the two big challenges, and then we'll go from there. Really anywhere you want to go.
Yeah, I think one of the biggest problems in the industry, or people who are trying to understand what's happening in the industry, is they do not realize the sheer volume of complexity around the number of players and the type of players that involve. And one of the things I promised you right before this call, Ryan, is that I'll go ahead and create a document, because I am a consultant, so I must have a chart. And normally I charge for this. So free for showing up today, you get a chart. Yep. But the chart is going to sort of describe that we understand the role of the realtor, often referring business to a mortgage originator. The mortgage originator works with the consumer, determines what their needs are, determines a good place and a good product for them. Mm-hmm. That is then funded by a lender. We all know that too. At closing, you sign a document and there's a name on it. That's the lender, except then the loan is sold.
Yeah. Almost
invariably. And the exception to this is the roughly 0.25% of the business, which is originated by a lender and put in a portfolio. Think big bank. So the big banks in some cases will put a loan on their portfolio. They are, at that point, become the investor. And they also, so at some point it is sold to an investor. Normally that investor in essence is Fannie, Freddie, or the government agencies, Ginnie Mae, so that's FHA, VA. Mm-hmm. And then there's a servicer. And the reason I think this is critical is we get sloppy with our language.
Yeah.
We say to consumers about this forbearance program that hits the headlines across the newspaper that you don't have to make your mortgage payment for 6 months because you're going to get a forbearance. We'll talk about that in a second.
Right.
But that you work on with a servicer, because the servicer is the one collecting the mortgage payments, and that name servicer implies and is true they are servicing for someone else.
Yep.
Which is the agency who wrote the rules. So the reason I bring it up is if you are on the front line as a loan officer, or you're on the front line as a realtor, mm-hmm. you're going to get a customer call you up, and you ought to immediately pivot to using the right language. Because it is important that consumers understand they're going to deal with a servicer in order to try to get something to help them in their time of crisis based on the rules by the investor. And, often people miss it. They just lump it all together. So it's the lender. And it's not necessarily the lender who can do and give you these programs that you need help with.
So we already have
a servicer who can help you.
We already have our first takeaway, Garth. This is so good
yes.
because I'm actually really proud of the mortgage industry. They have gone to create content around this forbearance conversation, and they're trying to really explain it because the media is not doing a very good job. So takeaway for the people that are doing videos, first of all, thank you, it's awesome. But pivot and add this conversation and this piece of clarity in there that Garth just talked about, because I think that I've seen a lot of videos, I haven't seen too many people clarify the servicer and the actual investor. So add that for the first takeaway already in the first 5 minutes to your content that you're creating. I love that you're creating it, but let's clarify servicer and lender.
Yeah, and by the way, and I'm not going to name names, but on one of the television programs was one of our preeminent politicians who is involved in this at a very deep level. And he said, call your lender, and then occasionally said, call your bank. And I was literally at home. Now, this was a day I hadn't showered. So if you want the visual, it's hat, T-shirt, hair's all messed up. But I'm literally screaming at the TV going, dude, it is not the bank or lender that they need to be calling. It is the servicer. And granted, they may think it's synonymous, but it's not.
Well, second takeaway already. It's so interesting that I know who the person you're talking about. It's so complex, one of your first points, that some of our high-level politicians don't even understand. I mean, look at the Fed. They went in and started buying mortgage-backed securities as an emergency measure. And I'm not trying to critique them because things are happening fast and they're just trying to help. Well, that actually caused a bigger problem with driving margin calls. Thankfully, we're seeing them back off, but the Fed didn't understand this. And the person that you're talking about, this politician, doesn't understand it. It's so complex that people that run the Fed and make policy struggle to understand. So if you're an originator, realtor, it makes sense why this is hard, difficult to grasp.
Yeah, well, yeah. So I think that's a big one. I think the second thing is somehow we need to have empathy for the people in the servicing departments, and we need to somehow get that across to consumers. So I'll talk in a second. There's the whole empathetic response model. It's a big part of what psychologists use, what sociologists use, trying to drill into what is really impacting the way someone feels. And it's a sales model too. How do you to truly understand? Well, these customers under stress, many of them. We need to have empathy for them. I'm going to talk about that in a second. But you need to have empathy for these poor servicers. Because in addition to what's happening in our industry, we've got literally every one of these people, these huge servicing shops, got sent home. Because for the most part, servicing was not a remote work model. Servicing was a cube model in big facilities, and in some cases an offsource model, and in some cases an offshore model with people in India doing work. They're closed too. So we literally, it took an industry servicing, which is mostly not remote, and said, y'all are become remote workers.
Yeah.
So they are literally sitting at home under the same stress we feel like sitting at home. As originators, of course, we know if we can get some loans through, we make some money.
Yeah.
And that's a good thing.
Yep.
Well, they're literally the other side of the equation. If they can deal with one more upset customer, they can get their hourly wage, and maybe they'll get time and a half if they can go 10 straight hours working in their living room with the kid being, taken care of in the back room. It is brutal. So the consumers, as you're a loan officer and the customers are calling you and getting all angst, they also need a dose of how tough it is on the other end of the phone. Here's some tips on how to deal with it. Being prepared, having your documents ready. Don't get mad. Don't yell at them. They're humans too. And you're going to have to be patient because the industry is not quite ready, servicers, for this onslaught of thousands and thousands and thousands of forbearance and or modification requests. It's going to be bloody.
Can I ask you a question that the independent mortgage banks are kind of struggling through now, like speaking of servicing? And it seems like, some of the bigger companies will service themselves, right? And then you're talking about other servicers that, the MSRs might be sold to. And those seem to be drying up, at least the options are. Maybe it's just a short period of time. I've had a lot of questions from the street level about some of the IMBs that will service, but it seems like a double-edged sword. Am I right? So the value that they've had maybe yesteryear, I'm guessing maybe cut in half, maybe, I don't know what the real number is, but the values, I'm guessing, decreased for some of the challenges we talked about, but they're also set up to service when there's no other options. So is it a double-edged sword, or is it more of a positive or more of a negative right now?
Well, that's absolutely, and it depends.
Yeah.
So there's a couple ways to look at it. If you are a servicer and an originator, and you've been retaining your servicing, which means you've retained your customer relationships. The good news is you have more control over the way the customer might be treated in this process.
Right.
So that can be a very good thing.
Yep.
They were important to you on the way in. You want to get referrals. You want the realtors to continue to give you referrals. You want their next deal, and you want their kids' deal, and you want to build a sphere of influence. That's the model. Keep the servicing, maintain the relationship. Very, very positive. So you do have control. That's the good part.
Right.
If during the last refi boom, tail end of 2019, the people who do a good job with servicing, good job in customer satisfaction on the origination side, they had a very high customer recapture. That's also a really good thing.
Yeah.
Next time they got a loan, you got it.
Yeah.
The problem right now is an economic problem, is servicing, as you implied. I don't want to get too caught in the arcane economics of this, despite the fact this is what we do a lot for a living, is you hold an asset, which is the servicing, and that asset is the right to collect mortgage payments over a period of time. And that is on your balance sheet at a value.
Right.
And when it appears that the loans are going to default more than you originally assumed, the value goes down. And if their value, and if we think they're going to prepay, because rates have gone down and they refinance, so they will make their payments, but they'll refinance, the value goes down.
Mm-hmm.
As the values go down across the industry, all lenders
Right.
have to write down the value of the asset, which means it writes down their net worth, which means typically they got to put more cash or capital into the business.
Yep.
So that's a lot of where that cash crunch hit.
Gotcha.
So you asked the question, is it a good or bad? It
Both.
depends.
Yeah.
It both.
Yeah.
And if you're well capitalized and you have a lot of cash, or you have a financial backing that enables you to get cash, then it's painful, the sheer delta in that number. I mean, for big lenders, we're talking tens to not $100 million.
Right.
I mean, this is real money.
Right.
But it's putting money in because the value is low. And as long as the defaults don't get out of control, the value at some point will go back up. So if you get yourself through, the rabbit gets through the snake, at some point.
Yep.
And it smooths out, but it's a painful process while it's going on.
Gotcha.
So I think the big point though is servicing is going to be heavily impacted. And I want to point this out because I am been in the business 30 years, so I have been through .com bubble 2000, which I actually had the company mortgage.com and sold it.
Yep.
Coming out of the bubble.
Yep.
I went through bubble 2008. Where I was at ABN AMRO, which we sold to Citigroup. So I went through that bubble. And obviously we all went through, the aftermath in 2010, and even into HARP in 2012. So here's the piece I want to point out that also is going to make this painful, which is why I'm saying, think about the poor folks in servicing. When we went through the last bubble, 2008, the origination market tanked. That was painful. Everybody on this call that was a loan officer, whether you were an originator, broker, whatever, and if I said to you, where were you during the last boom, you would describe it.
Oh, yeah.
You would say, companies going under, painful.
Yep.
Well, those people and staff were able to help on the servicing side when the servicing and default skyrocketed. They had time to help. And in some cases, you had processors who became loan modification experts. And you had underwriters who could do the agency waterfall around the loan modification process. You had industry capacity because the origination was low that was able to help on servicing. And it might have taken a while for people to migrate, and then a lot of them migrated right back when the origination market picked up. We don't have that now at all because not only is everybody working remote, but the originators are buried with refinance.
Oh, yeah.
And anybody has relock, pipeline fallout, re-underwrite to guidelines. This guy no longer has the job he had when he applied. I mean, it's just painful on the origination side, just trying to get these pipelines closed. Painful on the servicing side with the tsunami coming. And we really do not have a lot of capacity in our industry on either side to juggle with this. Am I making you sick yet?
No. This is all exactly why I wanted to have you on, man, because you have such a unique perspective.
I mean, it's going to be painful. And a big part of what, we think the solution, whether you're on the servicing side or the origination side or a little of both, it really is, once again, you got to focus on people, process, and technology. There are certainly a much higher adoption level around digital technologies now
Yes.
by consumers than there were in the last.
Yep.
In the last bubble in 2010, it was fill out a form and get to a fax machine. If you said to people in 2008, well, make sure to find a scanner, and scan it, would be like, what I got, a Staples?
Yeah,
Staples
out of
still existed
necessity,
back then.
all of the technology we've had will finally be leveraged. I was just making this point on a call last night. You can't go down to the mortgage company and say, here's my tax returns. You got to leverage, vendors like Blend or something like that. And so I know you've struggled with, and lenders have struggled with technology adoption. One of my favorite sayings is out of necessity is the mother of invention. So now all the technology we're being forced to use, but it's a good thing. And there's several reasons why we're going to be better on the backside of this. I think that's one of them, right? Consumers will also be trained to use it. Loan officers that are, a little bit stubborn will be forced to use it and master it. So we're going to be more efficient on the backside of this. And I think that like e-notaries and things like that are in the works, but maybe not mainstream. I think that's going to be mainstream at the end of this, and that's a good thing as well.
Yeah, absolutely. We have a very large client we're doing a lot of work for, and they have been thinking about and discussing e-closings.
Mm-hmm.
But they do enough purchase that it's kind of hard, and it's different. They're in a lot of states, and there's some. They really even said strategically, I'm a fast follower.
Yeah.
I'll just wait till someone else figures it out, and then we'll do it.
Yeah.
Now they're like, how fast can I have it up?
Yep.
Because I'm literally, I'll lead the way. Just tell me which way to go.
Yep.
So they need to do it like yesterday, and they're working on it today.
Yep.
So that's at least a good start. So I've kind of talked about the people and the empathy around it and the technology. The other though is, we have in every one of these rules that come out, and the MBA is doing a great job, and they aggregate it on their website. Fannie Mae just released this piece. Freddie Mac just released this piece. Here's what Ginnie Mae said. Here's FHFA's latest. And they're packaging it. So I would encourage anybody in our industry, go to the MBA's website, go to their Coronas page, bookmark it, get the notices, check it every day, because the information is there. They're aggregating as best they can, or as fast as it comes out. Every one of these one-pagers that comes out is a process that's probably this long.
Oh, yeah. Great point.
they came out with hey, we're going to be more flexible on verification of employment. And then they put out a grid that says, here's what flexibility means that might have 3 bullet points. Yep. It's very digestible, but somebody better operationalize that, i.e. design a process.
Yeah.
We do this first. Next, if this one doesn't fail, what's the escalation points? That type of thing.
One of the street level challenges, you bring up VOEs, and we didn't, I didn't think we were going to go here, but this is real time, and for lenders that are watching, you'll understand. Realtors may not understand this, but with FHA and VA loans, they have streamlined versions of refinances, right? And when a lender does that, they don't typically have to do credit or income verification. It's actually pretty nice because we can help a family save some money and lower their overall outgoing. The challenge, though, is if you're doing one of those loans, you're not verifying income, and you're not verifying really if they've been laid off, or you know what I mean? So you could be doing loans and putting them on your book and servicing that may be in forbearance or may go into forbearance right after that. So I was talking to Barry yesterday, and it's a sad analogy, but it's like, it's like trying to help a drowning victim. If you don't do it properly, they can tend to pull you down, and not, that hasn't even been mainstream yet, but that's stuff that's happening on a daily basis. Lenders have to think through, like, we really want to help this family, but man, if I do this, there's a real likelihood. If unemployment's 30%, a third of the loans might have forbearance or may not be able to pay. So I don't know if you talked about that with some of your lender partners, but that's something that we're having to think through at a street level right now. Like, how do we do that properly and not put ourselves at risk?
Well, yeah. So I think one of the pieces that's going to be an outcome of it, and the painful part, and it is painful, but it's also, if you're in the industry, it's understandable. So how do you articulate this in an empathetic way? The painful part is the industry starts by saying, my risk elements have gone up. And we often make decisions on layers of risk. So I'll take a little risk here, but I don't want to take high debt to income ratio and a low FICO score.
Right.
That's a layer of risk.
Right.
a layer just got added to everything, which is all original default assumptions are increasing because of the COVID-19 crisis. So because of that, I also don't want a low FICO score if I'm an investor. Once again, let's be careful with the language, not the lender, the investor.
Yep.
So therefore, anything under 660, we don't want to do anymore. Anything 680 and under, we don't want to do. Anything that the cash out under whatever, the guidelines better than I do, but every single day we're tightening the credit box.
Yep.
So there's a whole bunch of consumers who might actually not even be in this crisis because they are first-time home buyers.
Yeah.
And they were told very well that, it's 620 and above FICO and you save 3% and you probably can get a loan. I can help you with that. And the realtors are out shopping with.
Yep.
Right now, that way they can't get that loan.
Yeah.
And I don't want to like right now, it's dried up. The issue is, what do you do with them? And it's a long nurture. It's the same long nurture strategy you have on any pre-approval. It's going to take them a long time to find the home. Assumption's been it's going to be easy to get the loan. We need to pivot to think about it may not be that easy to get the loan, and we need to nurture them through the steps necessary. Be sure to keep their credit score up to, not take out a ton of debt if possible. What are the implications of the credit score and using the credit tools that tell them? Because at some point the programs will come back and we want them to be in a position to take advantage of it. So whether you're a realtor or a loan officer, you need to be prepared for a long nurture on consumers.
Yeah,
I answered a question. I don't know if I answered your question, but I felt that was an answer to a question.
Yeah, well, because what's happening real time is realtors, I get it, they don't necessarily understand, and so they get mad at their lender because what used to be a deal yesterday may not be today, and so they'll, I've seen a lot of posts and a lot of high-level people mistakenly, just throwing stones at the lender, and they don't understand why, what you made the point of layering risks, and a lot of them are just trying to make it through and survive right now, so they're not trying to, they're not trying to be a bad cop or anything, and they'll say, well, I talked to FHA, and FHA didn't change anything, so why is the lender? Well, guys, hopefully now you kind of understand the predicament that we're in. We definitely want to open up. That's how we all stay in business, is doing these loans and selling them on the secondary market. That's how we generate revenue. But we can't do so many of them, especially in this environment, to where we have to, purchase that loan back or keep it on our warehouse lines. It really puts us in a bad position. So I think the good news, and I kind of want to wrap it up with some good news if you have any, I think this is short-lived. I'm not smart enough to know how long that'll be. If it's 2 weeks, 3 weeks, a month, or two, I think at some point we get back to normal and we'll look back. And again, like I said earlier, we're going to learn from this and we'll all be better. But we can get through it. And I don't think that this is the industry as we know it moving forward. I just think that this is a period in time.
I think so. Here's a few things that I would say if you're in the origination side, is that you need to be an advisor, whether it's your job or not. Because your job would say, I'm not in the servicing business and I sold your loan. There's ABC, call them. I can't help you. And that is not a great message if you want to be in the referral business.
Right.
And frankly, if you want to do the best thing you can, we're all in this together with this crisis. So we're all supposed to be sheltering at home, but we're supposed to be reaching out to people through other methods. So if you can create to the best of your ability that reinforces who is the servicer, the fact of their rules, tips on dealing with them. By the way, this happened. Next week, supposedly this is going to happen. I will be sure to keep you updated. It's not your job, but it might be your mission.
Yeah.
And it might be a great way of adding value. And if you CC the realtors who are involved with the transactions, and if you get them involved in these transactions, these people can be nurtured through, even the ones where it's going to be a very painful process. And even those where really it's the servicer's, quote, job, you can still help them.
Yeah.
And I think that's a very, a good way of feeling that you're doing the best you can for those people in your sphere of influence that you've built over years. And, I think, frankly, it would make me feel better. We take a lot of phone calls from lenders who just kind of, in some cases, like, what are you hearing? What do you want to talk to? And, we don't charge them for it. We're not trying to go right to an engagement. I'm just often trying to listen to, the pain they're feeling and saying, this is what we're hearing, and have you thought about this? And I think that's kind of the right way to do it. I think most of us, I've been in the business 30 years. I hope to be in the business for, decades. And at some point, we all kind of got to do our part.
Right.
So it will. The other is when consumers call you. So you're communicating, you're trying to give them some good information, you're trying to help them through the process. The other is be sure you are highly empathetic, because you're going to get frustrated. But it's not a dumb question when the consumer doesn't understand the difference between the lender and the servicer. They don't understand who Fannie and Freddie is. And to the extent you can have a document that sort of describes it and an empathetic way of describing it, maybe even if you do, set up your own small communication strategy, your own small webinars where you tell people, or, hey, why don't we get your wife on the phone and walk through this? Because I know it's tough for you too.
Yeah.
So I'll help you as much as I can. I mean, I think that's really the only thing we can do right now.
Yeah. I will say this, man, for Garth and Stratmor, which I appreciate your time, man. I'm so thankful for our friendship. One of the best compliments, I was talking to RC yesterday, we've had a couple hundred subscribers just almost, it seems like daily, just because we've been everywhere. And the best compliment is a lot of them are high-level C-suite people. A couple CEOs I saw this week, I won't shout them out. And so I know that over the last year, we've had quite a few C-suites kind of tune in and start listening. So I'll say this for Garth, you're probably already working with Stratmor, but if you're a smaller company and you're struggling like everybody is to get through this tough time, reach out to Garth and Stratmor. He's one of the most connected and smartest people I know in the industry, and this is what he does on a daily basis. I know that also is true for bigger companies, because everything we're talking about just gets compounded if your volume is that much bigger. And so really, big to small, if you're not working with Garth or Stratmor, I encourage you to reach out to him, even if it's just a conversation like you just said. I think that'll lead to edification and refinement, because I'm doing on a daily basis too. I just hung up with 17 regionals and we were sharing ideas, and that's what I love about the business. I don't want anybody to go down or lose their job, and so we're sharing best ideas, best strategies right now, and that's what Garth is doing right now for us. So I appreciate your time. We will put his information in the link below. Terrific. And we'll see you guys next week.